Thank you for joining us for the Cherry Bekaert's 2023 Tax Credits and Incentives two-day virtual conference. This is day 2, and we thank you for attending yesterday's sessions, and we thank you for the participants that are attending session number 3 and the balance today. My name is Ron Wainwright. I'm a strategic tax partner with Cherry Bekaert, specifically in the tax credits and incentives advisory practice. And I'm fortunate to lead our cost segregation and our energy practice. Our first session today is centered around cost segregation, as well as a focus on 2 energy tax credits and incentives that are very specific and intertwined within cost segregation, specifically Section 179 Cap D, as well as Section 45L. Each session today will be led by TCIA professionals from partners through managers who will share tools, tips, and techniques regarding these topics. We hope you're able to join the rest of our sessions today that deal with research and development credit, as well as other matters. I'd like to introduce first our speakers. Sean O'Leary is a senior manager on the cost segregation team. Bill Harbison is a manager on both the cost seg and energy team. And Dat Lagun is a manager specifically on the cost segregation team. So let's get started. From an agenda perspective today, if you could change, there we are in our pictures. But from an agenda today, we want to give you an in-depth but a deep dive in cost segregation and what in fact is a cost segregation study and how does it work and what are ultimately the tax benefits derived by completing a cost segregation study. As mentioned, we will expand on several of the provisions that are very specific to cost segregation around energy. And of course, the Inflation Reduction Act of 2022, now 1-year anniversary today, expanded significantly Section 179 Cap D, or what is referred to as the energy efficiency deduction, as well as the residential and multi-residential credit referred to as Section 45L. So this brings us to our first polling question. Has your company had a cost segregation study conducted? A, yes. B, no. Not sure. What is a cost segregation study? And we'll give you about a minute to complete the poll. All right, let's post those results there. So yes, 25%, no, 36%, not sure. And what is a cost segregation study? So across all these answers today, we want to make sure in our deep dive, you fully understand the opportunities attributable to a cost segregation study. So what is it? Let's start with the basics. It is a tax consulting opportunity from a depreciation perspective of real estate that ultimately helps taxpayers reduce their tax liability. We, on the cost segregation team within Cherry Bekaert, have a number of engineers. And so when we think about it, it is applying tax law attributable to the building, whether it's commercial, multi-residential, mixed use, with respect to an engineering approach. The process that we employ is that we segregate portions of a building that's either been purchased or new construction or renovations or expansions into ultimately what the tax law allows as what's referred to as class lives. So we're attempting to take a 39.5-year asset, which is straight line for depreciation purposes, or what is a 1250 asset. And we're, from a structural perspective, evaluating that building, purchase or new construction or renovation and or expansion, and appropriately treating the class lives, which ultimately allows to depreciate faster, whether that's under bonus depreciation or in fact the class life that is been identified underneath the modified accelerated cost recovery system. Ultimately, it produces a higher depreciation expense, i.e. a lower tax liability and a significant tax savings in the year in which the asset receives either a temporary certificate of occupancy or a certificate of occupancy. But ultimately, the takeaway is it is to assist taxpayers in minimizing their tax liabilities as they purchase, construct, or improve real property to reduce their tax liability in very early years, as opposed to 39.5-year straight line, or if we're dealing with multi-residential, 27.5-year straight line. Next slide. So let's look at an example. In a basic example, we purchase a building at $3,900,000. And if we did not do a cost segregation study, we just depreciated over 39.5-year straight line, which is what the tax law tells us we must do. Our first year depreciation expense is approximately $100,000. And then in the second year, it is again $100,000 over the straight line. However, if we complete a cost segregation study and we identify real property assets under 1250 that in fact are not in a class life over 39.5 years, we look at 5, 7, 10, 15-year type class lives around the structural, and we move them into what is referred to as 1245 property, thereby allowing us to apply makers or accelerated depreciation. But most importantly, we are then eligible for bonus depreciation. So in this simple example, if we completed a cost segregation study on the asset that we purchased for $30,900,000, we have the opportunity through a cost segregation study to immediately depreciate and therefore expense $1,140,000. So it generates a first-year tax savings utilizing a 40% rate of $456,000. The key here is, of course, time value of money. Depreciation or any expenses you want to accelerate in basic tax planning while you look for opportunities to defer income into future years, if applicable in the tax law. So going through another simple example, this just basically looks at 5 years and 15-year assets and 39-year assets. And so, from a depreciation perspective, we are again shifting cost to other asset classes or class life assets pursuant to the IRS guidance. And then we are able to accelerate that depreciation into earlier years. So again, if we just took the asset at $3,900,000, we would see that $2.7 million would be 39-year asset, and all property usually has some amount of 15-year and some amount of 5-year. But in this case, we're able to, through the cost segregation study, accelerate $1,240,000 of immediate depreciation expense. So Dad, why don't you join us now and talk to us about asset classes for tax purposes and how we move 1250 into 1245 and what that means.
Thank you, Ron. Hello, everyone. Once again, my name is Dat Ling Nguyen. I am a manager in the TCIA practice specializing in cost segregation study. And on this slide that you're currently looking at here, I want to talk a little bit about the modified accelerated cost recovery system, or also known as MAKER. This is the current system that we all use when it comes to depreciating fixed asset. So as Ron mentioned earlier in the two example, a real property such as 27.5-year residential or 39 years commercial, generally depreciating under straight line method. But when it comes to things like 15 years land improvement or 5 and 7 years personal property, this is when the MAKER system really shine. This is when the taxpayer is allowed to treat them or depreciate them as 150% or 200% declining balance. So obviously the whole purpose is to accelerate depreciation and push some of that depreciation expend to the earlier years and to increase cash flow. Okay. And on this slide, I want to mention a little bit about some of the typical asset or building component that we encounter for 5 and 7 years asset when we do a cost study. So in general, generally speaking, 5 and 7 years properties, they are either decorative in nature, so things like decorative lighting fixture. They could also be infrastructure, mechanical, electrical, or plumbing infrastructure that were installed to for a specific process or dedicated to a piece of equipment. So, for example, things like a computer outlet, a break room appliance outlet, or also things like a special mechanical system that was installed for a special purpose. So, for example, let's say if you have a server room full of data and you install a heat pump or a split system to cool the server, that system, along with all the associated ductwork and plumbing, can be considered 5 years personal property. Also, finishes just such as carpet, vinyl flooring, resilient floorings, also personal property, cabinetry, obviously furniture, fixture, and equipment, and exterior awnings or canopy, provided they are fully removable. Let's talk about 15 years land improvement. And these are pretty straightforward. So generally speaking, any improvement made directly onto the land can be considered land improvement as long as they are not attached to any building whatsoever. So, you know, a good example include concrete paving, asphalt paving, concrete curve, storm drainage, landscaping and irrigation, your wood fencing, your metal fencing, as well as your metal gates and wood gates. Side light poles that are standing on their own, they are not attached to building, they are standing either on concrete pavement or on concrete foundation. Those are all land improvement, as well as all the associated conduit, electrical conduit underground, giving them power. Dumpster enclosure, they could be metal, they could be wood, they could be masonry, all qualify as 15 years land improvement. Sidewalk and side railing, these are all land improvement 15 years. Let's talk a little bit about real property. So as Ron mentioned earlier, real property I fall under 27.5-year residential or 39 years commercial. And the definition of real properties is basically any remaining structure and building components that are not personal property. So obviously the definition is sort of opposite of personal property. So these components or assets are not decorative in nature. They were not installed for any specific reason. They are there to basically for the general usage of the building. So think about of a fluorescent light fixture out in the hallway to light up the hallway so that people don't walk in the dark. So that fixture would obviously be considered for general usage of the building and not personal property. At the bottom of the slide here, there's a third category for real property, and they are called qualified improvement properties. And if you notice, these are 15 years instead of 39. The reason for that is because if they are essentially 39 years property, but they can be converted into 15 years as long as they meet the following condition. The improvement has to be exclusively interior improvement, which means the envelope of the building has to remain intact along with all of the structural framework. So things like beam, columns, foundation, concrete slab, those have to remain intact. Also, the improvement cannot be related to elevator, escalator, and you cannot gain any square footage. I mean, they really want the building envelope to remain intact. You cannot gain any square footage. If those conditions are met, The improvement can be considered qualified improvement property, and they can be converted into 15 years, which makes them eligible for bonus depreciation, which I'll be covering in the next few slides. Okay, so before we go into bonus depreciation, we have a quick history of the maker system and how it all began. As you can see, between 1913 and 1934, there was really no regulation whatsoever. The taxpayer sort of had full control as to how they treat their fixed asset. Starting in 1934, the IRS started to require taxpayer to justify or prove their choice of depreciable life that they assign for this fixed asset. In 1942, the IRS released Bulletin F, which was essentially a long list of asset and their recovery periods. You can see that as their first attempt to standardize the way fixed assets is being treated. In 1954, Congress began to authorize the accelerated depreciation method as an attempt to incentivize taxpayer to make investment into the economy. In 1962, 20 years later, that Bulletin F is finally replaced with guidelines of how to treat fixed asset. This is also when the IRS going back to requiring the taxpayer to once again prove their recovery period choices that they apply to that fixed asset. In 1971, the asset depreciation range system was implemented. This system essentially provides a broad classification of asset. And in 1981, the ACRE system was enabled. It did not last long. 5 years later, it was quickly replaced by the MAKER system that we still implementing and using today. Okay, let's talk a little bit about bonus depreciation. In general, bonus depreciation is only applicable to personal property. Basically anything that is 20 years of recovery period or less, which means all of your real property, your 27.5 years residential and your 39 years commercial properties are not eligible for bonuses unless they can be converted into QIP, as I mentioned earlier. Okay, so the amount of bonus depreciation that you can take depends on which year the asset will place into service. And we have a table on the right here for you which sort of summarize the bonus percentage based on year. And if you notice, the bonus amount does phase down by 20% starting in January of this year. Again, this table the timing and the percentage are a result of the Tax Cut and Jobs Act, which was passed in 2017. Another thing to note about bonus depreciation, and again, as a direct result of the TCJA, is that the law no longer distinguish between used or new property. So prior to the TCJA, only new construction and renovation can be eligible for bonus depreciation. That is no longer the case. Thanks to this new tax law, well, you can now apply bonus depreciation to old property or used property, which means you can buy a property and still be eligible for a bonus. Okay, so before I hand it back to Sean, I want to touch real quick on an example of what we call a benefits analysis that we typically do for all of our cost seg projects. So the table on the right here is what you would typically see at the end of a cost seg project, sort of summarize what we did and what are the impact. So in this example, which I believe is a real life example, you have a taxpayer who purchased a property value at roughly $1.1 million. We went through a cost-X study and managed to reclass a total of $882,000, ranging between 5 years property, 15 years land improvement, 15 years QIP, and remaining 39 years real property. And because of the amount of reclass, if you look at the smaller table on the left here, we had a quick comparison. So if this taxpayer were not to perform or elect to do a cost-X study, the maximum amount of depreciation expend in the first year when the asset was placed into service, the maximum they can take is only $31,000, roughly $31,000. However, after we done a cost-X and after the result are being implemented, taking into account bonus depreciation, we managed to increase first year depreciation expend to $888,000. So as you can see, the number pretty much speak for themselves. There is significant benefit to have when you do a cost-X study. And if you're curious as to the cash benefit, we estimated the first year cash benefit as a result of this study is roughly $296,000 first year cash benefit. So once again, numbers speak up for themselves. There's a lot of benefit to be had with cost segregation study, and a cost-X study can really unlock the potential of your asset. And with that, let me hand it over to Sean, who will continue our presentation.
Okay, thanks, Dat, and good morning, everyone. So on this slide, we'd like to present another example of a significant cost segregation project that Cherry Bekaert recently completed to highlight the tax savings available through cost-Seg. So in this case, in 2015, a client of Cherry Bekaert's purchased a 26-story office building that was originally constructed way back in the early 1900s in Midtown Manhattan, which is obviously some very prime real estate. And this property is close to both Central Park and Trump Tower, so obviously a prime property. In 2017, they began renovating the building into a very high-end luxury hotel and condominiums, and that renovation was completed, and the property was placed back in service in 2022. So as you can see here, the building was purchased for about $478 million, and the renovation costs were about $577 million. Through the cost-Seg study, around $55 million of the building's purchase price was reclassed into 5-year personal property, and a total of $230 million of the renovation costs was reclassified into both 5-year personal property and qualified improvement property. So from a tax savings perspective, as you can see on the slide here, this resulted in a first-year depreciation expense of $247 million compared to if a cost-Seg study had not been done, and achieved a first-year tax savings of $99 million and a lifetime savings of $68 million. Obviously this is a huge project, and the costs and tax benefits are really immense. Our cost-Seg team at Cherry Bekaert worked for nearly 2 years with our client to see it through the end and to get these kind of results. But the main point to realize is that regardless of whether the property is a small purchase of a residential building or the purchase of and renovation of a large hotel like this one, is that cost segregation offers significant tax benefits on nearly any dollars of investment made into real property. Okay, next slide, Dan. So in June of this past year, the IRS released an updated version of the audit technique guideline as it pertains to cost-Seg studies. Much of the guidance was unchanged from the prior version of the ATG that was issued back in 2016. The updated guideline does highlight many significant changes to the tax law that have occurred since 2016 in relation to depreciation in general, specifically, again, the PATH Act of 2015, the Tax Cuts and Jobs Act of 2017, which Dad talked about, and the CARES Act of 2020. Again, the TCJA changed bonus depreciation rate to 100% for tax years 2018 through 2022, with the rate declining to 80% in 2023 and further declining in subsequent years. Going to 100% bonus again is a huge change that greatly, incentivizes taxpayers to make investments in real property. And the other significant change from the TCGA, as Dad mentioned, is allowing bonus depreciation on used property. And lastly, the significant change again with the CARES Act was a technical correction to change qualified improvement property into a 15-year asset class, which then allows you to take bonus depreciation on it, which we've already discussed is very beneficial. The audit technique guideline provides many other information points for taxpayers utilizing cost seg sources to consider. That if you could move to the next slide, please. The IRS points out that there are numerous ways to conduct a cost seg study, but emphasizes that the quote detailed engineering approach is the most accurate and frankly is the one that we always use for our projects at Cherry Bekaert. Other approaches can be used, but may be scrutinized more heavily upon examination. Many cost seg practitioners use a quote rule of thumb study and simply apply average results of prior studies to a new property without doing a site visit or closely examining the actual cost of building. The IRS is particularly disdainful of this approach and in fact says it is, quote, typically sketchy and inadequate. So taxpayers should take a close look at the type of study being performed by the practitioner and be aware of the risks if audited. The guideline does point out some other areas to watch for, including evaluating the amount of the purchase price of a building that is allocated to land to ensure that the amount is reasonable. The IRS instructs that the land should be valued on its, quote, highest and best use, but practically and technically, taxpayers should also consider approaches that are justifiable and that can be documented. Many cost seg providers use standardized land values for every and all properties across the country. From our experience doing cost segs, we recognize that land values are highly dependent on location. Land valuations for example, in Miami or Washington or Austin, Texas, are greatly inflated from those in smaller, less urban areas. And maybe most importantly, as far as the ATG, taxpayers should consider whether the results of the reclassification of costs into shorter life property from the cost seg study are reasonable given the type of property, its location, and where the costs were actually spent. Okay, next slide, Dad. Okay, up next is the cost seg process, which I'd like to spend a minute or two on highlighting what a taxpayer can expect during the course of a project. So first up is the scoping process, during which we gather up basic information about the building, including the address, the taxpayer or entity that owns the building, the cost used to either purchase or construct the building or an improvement or expansion, and when it was placed in service. That information allows us to estimate the potential tax benefits from the study, including the expected first-year depreciation expense, as well as the amount of cash savings in the form of reduced tax liability. At this point, we provide a complete benefit analysis along with the expected ROI and the costs to conduct the study itself. Okay, next slide. Once engaged to do this study, our engineers will take the information gathered through an RFI and begin to do a full detailed modeling of the building to reverse engineer it and develop a cost database of all the materials used in the construction. This allows us to then identify the shorter life property that is eligible for accelerated depreciation. We do need to conduct a site visit to ensure we accurately capture all the details of the construction and identify all the short life property. One area that is always a little difficult is the reconciliation of construction costs that you might get from, say, an AIA doc from the general contractor back to the amount booked onto financials, which may include other things like what we call soft costs, which would be like engineering and architectural fees, capitalized interest expense, and other kinds of fees that aren't a direct construction cost. Our team here at Cherry Bekaert has both tax CPAs and engineers, along with a number of tools that we can use to simplify this process. And we work closely with our client and their accounting and construction teams to get the right answer and make it as efficient and accurate as possible. Of course, once we finish the project, we provide a full report that includes detailed engineering schedules, depreciation schedules, and tax benefit amounts, along with other forms such as a Form 3115, which might be needed if the property was placed in service in a prior year. The Form 3115 is for an accounting method change that allows you to sort of catch up the results of a cost seg study on a current year return, like for now would be a 2022 return for maybe a building that was placed in service back in 2020, for example. All right, next slide, please. Another type of project that we frequently help our clients with is what we call the fixed asset review. We very often find our clients have depreciation schedules that can be a little messy and cluttered with years of fixed asset additions for their real estate holdings. Since their expertise is not generally in the tax treatment of fixed assets and depreciation, this can often mean that there is significant tax value in examining these records to find fixed assets that may have been misrecorded. Many times, real property additions simply get recorded as 39-year property, when in fact, these additions probably have both personal property, qualified improvement property, which both, as we discussed, both of which are now eligible for bonus depreciation and much shorter depreciation lives. So a fixed asset review is an examination of a client's depreciation records to find assets that may have been miscoded and help our clients get their fixed assets records straightened out in an agreement with their financial records, as well as the tax law. Since many of these assets have been placed in prior years, again, this might mean filing an accounting method change on Form 3115 to take the benefits of the review on a current year return. Okay, next slide, Dan. So in this slide, we look at an example of a fixed asset review that we did for a client of ours that owns numerous manufacturing and commercial properties across the U.S. and had hundreds of entries on their depreciation schedules that hadn't been closely examined in many years. Our review identified around $2 million of real property across 20 properties that contain property eligible for reclassification of some of those amounts into shorter life treatment. We identified 2.5 million out of the 2.9 million that was either really 5-year personal property or qualified improvement property, which resulted in a potential first-year tax savings of around $1 million. So the bottom line is it can make a lot of sense to have a periodic review of your fixed asset schedules to ensure the assets are being recorded and treated correctly, and sometimes can lead to significant tax savings through a fixed asset review. Okay, next slide, Dad. So this slide here, we're going to talk about qualified improvement studies. A qualified improvement study is sort of a subset of a fixed asset review. It's very similar to a cost seg study, but is geared towards recently installed real property additions on existing buildings. Again, as Dat mentioned, it has to be an interior. A qualified improvement property is the interior improvement to an existing non-residential building. It can't be for residential property. And so the investment made might be, for example, for renovation of an office space. Tenant moves out and it's time to redo the interior portion of it. This type of investment might be for, $250,000 or even less, even $100,000, maybe on up to $1 million or $2 million, just depending on the specifics of the project. So it may not warrant a full cost seg study, but the analysis does provide assurance that the assets are properly recorded and at the same time maximizing the tax benefits through that investment in the real estate. Okay, that's it for me. Now, next up is my colleague Bill Harbison, who will discuss the energy incentives of 179 Cap D and 45L. Thank you.
Thank you, Sean, and everyone on the call today. Thank you so much for having me. Again, my name is Bill Harbison, a manager within our energy services team here at Cherry Bekaert. Today, we're going to go through some of the energy incentives surrounding new and renovation construction, specifically the 179 capital D and the 45L incentives. Before we really get into the details here, we got a polling question for you. Pretty straightforward. Do you own a commercial building or work as a designer on a commercial building? Yes, no, not sure. We'll give it a couple of seconds here. Yeah, we're not getting the poll here. There we go. All right, we'll give it just a few more seconds so we can close it. All right, let's move on. All right, so we got a lot of yes, no, not sure, pretty spread across the board here. So hopefully our information today will help guide some of our decision making, tax planning, et cetera. But again, before we get into the details about 179D, I'll say that one of the things I really like about the 179D incentive and the 45L incentive is that while they're both complex in their application and how the studies must be performed, they're also very accessible. For those of us that joined us yesterday to talk about the Inflation Reduction Act, you may be thinking, well, I don't create biodiesel. I don't have a nuclear energy plant, things like that. Well, the Inflation Reduction Act does account for business owners like normal people, small and medium-sized business owners that own their own buildings, their own facilities, or occupy their own facilities and do renovations to them. So however, these were not introduced as part of the Inflation Reduction Act. As you'll see here, the 179D incentive has actually been around for almost 20 years. It is called the Energy Efficient Commercial Building Deduction, pretty straightforward in its name. And again, been around since January 1st of 2006 as a way to incentivize designers and owners of energy efficient commercial buildings. The Congress realized as part of the Energy Policy Act that one of the worst wastes of energy in the United States is commercial buildings. Probably the #1 consumer of electricity is commercial buildings. So they want a way to incentivize the owners of these buildings to either construct brand new energy efficient buildings or do relevant upgrades to their buildings to bring them into the modern standard. So what it allows for is a deduction of up to $1.80 per square foot for an eligible space. An eligible space is one that has received upgrades or new construction, again, to either the HVAC system, that's the heating and air conditioning system, the interior lighting system, and the building envelope. The building envelope includes the fenestration, the doors, windows, insulation, roof, et cetera, all the pieces that make up the exterior of the building. If upgrades have been done to the building or again, new construction, then there can be a deduction in the form of an accelerated depreciation, very similar to cost segregation. In fact, where cost segregation leaves off with 39-year property, 179D picks up the slack and we're able to fill in some of the gaps, allowing a eligible taxpayer to claim even more deductions against their building in addition to cost segregation. So one of the really exciting things about 179D happened in 2008 as part of a major expansion of the 179D incentive. So in 2008, I think everyone knows that there was a major economic downturn, and the Congress was looking for a way to infuse some money back into the hands of the people that make up the AEC industry, the architects, engineers, construction industry, while at the same time realizing that as you might predict, the government was, of all the commercial building owners, the worst offender as far as energy efficiency goes. The buildings were out of date and certainly not energy efficient by current standards. So a way to tackle both things at once is to allow for a government entity to allocate a 179D deduction to an eligible designer. So if I am a school district and I'm building a high school, I can then allocate a 179D deduction to the architect or the engineer or somebody else performing design services for that school, since they're not a taxpayer. So next page here. So that was old law. We've since received semi-annual or biannual expansion of the 179D incentives since its inception. Some major changes have happened. In 2020, it was made permanent as part of the CARES Act. And since then, an even larger expansion happened in the form of the Inflation Reduction Act, which was passed last year and took effect in this year. Some of the major changes or the expansion of eligible buildings. So as I mentioned, a government entity can allocate a 179D deduction. Well, that has since expanded to tax-exempt entities. So not only public schools, but now things like churches, things like charity hospitals, even tribal lands, because they don't pay federal taxes, can claim a 179D deduction for commercial building. And that includes Indian casinos, for instance. So the amount of eligible buildings is now all of them. If there's a building in the United States that has been recently constructed or newly renovated, there's somebody that can claim a 179D deduction against it. Some of the other major changes that we're seeing is a triennial, but also a 4-year reset of the deduction, and that depends on the kind of ownership structure. So it used to be that the 179D deduction could be claimed once in the lifetime of the building. Well, that has now changed. If you're doing relevant upgrades to a commercial buildings, you can claim a new 179D deduction every 3 years, or if it's a tax-exempt building, every 4 years. So another way to incentivize the regular upgrade of these buildings to stay up with the newest modern standards. You'll also see here that there are some new requirements, including prevailing wage and apprenticeship requirements that must be met. We're going to talk about them here in a little bit in more detail. But the major change here, and Dak, can you change slides, please? The major change, the very exciting thing that we're seeing is a near triple of the available deduction. So where we were once capped at $1.80 per square foot, the new maximum is now $5 per square foot. So significant changes in the positive for this incentive. So some of the technical changes that have happened: no more partial allowance. And what that means is, as I mentioned, HVAC systems, interior lighting, and building envelope were all eligible systems to be reviewed. So if I go in and only replace the HVAC system for a building, I can go in and claim a partial deduction. So 60 cents of the $1.80 if I do for instance, a single system upgrade to a building. Well, that's been eliminated altogether. Now the building must be reviewed in a holistic manner, which is a positive thing. We're seeing good results by reviewing the entire building as it exists today, and it's its entirety. And what that allows for is, again, no more partial deductions. So the way that it changes now is it is calculated on a sliding scale. So where the minimum standard to qualify used to be a 50% energy cost savings per year calculated, that has been now reduced to 25% annual energy cost savings as a minimum threshold to qualify. And we save 2 cents per square foot per percentage point, between 25% and 50%, at 50 cents a square foot or $1 per square foot. And then if you meet those prevailing wage and apprenticeship requirements that we discussed earlier, that goes to 10 cents per square foot. So $2.50 per square foot to $5 per square foot. I said a lot of numbers just now. The key words that I want everyone to take away is $5 per square foot for an eligible space. So massive savings available for a taxpayer. All right, next page, please. Okay, so a little bit about the 179D process itself. As I mentioned, it's been around for a long time. The incentive is almost 20 years old now, but it is one of the least understood deductions, but also one that's taken advantage of very rarely compared to things like cost seg. And one of the reasons that is because of the complexity. There is some kind of hurdles to overcome when it comes to actually performing a 179D analysis. One of those is the energy modeling process. Here at Cherry Bekaert, we have an in-house energy modeling team of experts that this is all they do. They've made a career of doing 179D analysis, and we're lucky to have them. But their process is to secure some energy modeling software first and foremost. The Department of Energy has approved about 15 pieces of modeling software that we can use to conduct a 179D analysis. The one that we use is called the hourly analysis program. It's actually made by Carrier, the HVAC company, and it is allowed for contractors, engineers, other building professionals to actually design and analyze HVAC systems, as well as interior lighting and, of course, building envelope systems to ensure that they're meeting certain energy cost thresholds for their relevant regions and states. We can also use that software again to conduct a 179D analysis. The way it works is that we will build two models of the same building. We will take your building, or your client's building, as it exists today, including all of the planned upgrades to it. So we take into account every component of the building, how big it is, of course, but the kind of HVAC system that's in there, the kind of lighting, but also the orientation of the building. Where in the country is the building? How much sunlight does it get throughout the day? We also take into account the kind of occupancy it has. Is it occupied 8 hours a day like a store, or 24 hours a day like a hotel or a hospital? All of these things we take into account. And then we will run that model for 365 hypothetical days. We will then build the exact same model as if we're built to ASHRAE 90.1 of 2007 standards. So I really want to highlight that standard here. 2007, of course, was close to 15 years ago. What that means for us is that the definition of energy efficiency is a little bit different than what the IRS is looking for. So while you may be out there thinking, well, I don't do energy efficient construction. I built to minimum standards. We're always in cost saving mode, things like that. Or I built high schools, right? We're not putting in geothermal systems for a high school because it's a public building, things like that. What I want everyone to keep in mind is that, again, we're comparing your building as it exists today to a very old standard. Technology has progressed significantly just in that amount of time. For instance, almost every commercial building in the United States now is built with LED lights versus halogen or fluorescent lights not even 10 years ago. So when we are running these models, we're seeing energy cost savings of 50% or more regularly. So here's on the right side of the page a quick example of one of the studies that we're doing right now. Pretty straightforward, a 400,000 square foot building, public high school, again, built to minimum standards of the day, which is 2023, and we're already calculating a 52% annual energy cost savings, which is going to yield a $2 million deduction for our client. In other words, they're not going to pay taxes for a couple of years. So a lot of positives. Next page, please. Okay, next page. We already went through HEP. All right, so again, just to kind of reiterate some of our processes here, one of the things that we really pride ourselves in and that sets ourselves apart, in addition to having an in-house energy modeling team, is the detail that goes into an energy modeling process. A lot of 179D providers or so-called providers may say, all right, we've got this energy modeling software. We're going to input our data into it and we'll see what comes out. Having a mastery of the inputs and, of course, the outputs of it is what provides a accurate model, which is important for the sake of calculating the largest and most accurate deduction, but also supporting that model in any sort of review should one come up. Next page, please. Going through this one, next page. All right, so again, just to kind of reiterate some of the massive numbers that we're seeing throughout the 179D space. This is an example of an engineer that we were working with. They do architecture and engineering as well, excuse me. Last year, we did a study for them for 9 different buildings in the Memphis area, ranging from municipal buildings like fire stations through large high schools. So a pretty wide range of buildings and their size and use. Again, we compared these to the ASHRAE 90.1 of 2007 standards, and we analyzed about 800,000 square feet on their behalf. We calculated for them a $1.4 million deduction, otherwise a $570,000 tax savings, that reduction in that tax bill there. they're able to do so without taking any actual losses. This is a just straight depreciation, or excuse me, a straight deduction in their tax liability. So the other big advantage here is that this came at no cost to the building owner. Because these are federal tax dollars, we are not going to the government clients of these taxpayers and saying, hey, give us some money, we saved you money. That's not how it works. This is coming straight from the federal government. So really no ask of very much anyways of these tax exempt owners. I think we got another success story here. Next page, please. Oh, okay. Yeah. Moving on to our 45L section. So I've been talking a lot about commercial buildings. What is a commercial building for the purposes of Congress and the IRS? Well, according to them, there are two kinds of buildings in the United States. There are commercial buildings and there are homes. If you are not a home, then you are a commercial building. And what that means is a home is single family or a multifamily that is under 4 stories. So 4 stories and above grade, above ground floor is considered, while multifamily, also a commercial space. So any kind of building in the United States is covered between 179D and 45L is what I'm getting at. So just like 179D covers energy efficient commercial buildings, the 45L incentive is for energy efficient new homes. And we'll get into some detail here now. Dan. Okay, first a polling question. Do you own a residential building or work as a designer on a residential building? And we're looking at home developers, home builders, commercial real estate companies, things like that. I'll give that just a couple seconds here. All right, let's go ahead and close the poll. All right, again, pretty even spread between yes, no, and not sure. So let's jump in here into the 45L space. Dat, next question. Okay, so a little bit about 45L before we get into some of the big figures here. Just like 179D, 45L, and you'll have to forgive Congress for not being more creative in these names. It was enacted in 2005 as part of the Energy Policy Act. It has been extended on a semi-annual basis since then. And what it does is incentivize, again, the design and construction of energy efficient single, multifamily, in assisted living facilities, student housing, things like that. So any kind of residence. It allows for a credit of up to $2,000 per unit. So for a single family home, obviously $2,000, but for a $2,000, for a multifamily building, such as an apartment, every individual unit can receive $2,000. So for, say, an apartment developer, the credits can add up very, very quickly. But also for single-family home builders that are building these big subdivisions with like 100+ homes per year, that $2,000 can add up again very fast. With a limitation for pre-manufactured homes to $1,000. The limitation, again, as I mentioned, is to 3 stories or above, or excuse me, 3 stories or below above grade. Anything above 3 stories is considered a commercial space. So who can qualify? So what it is specifically made for are developers and contractors of these residences. So the party that puts the basis into the building originally will be the party that is able to take advantage of the credit. Congress recognizes that oftentimes these homes or multifamily units almost immediately get leased or sold, and as such, they would be kind of losing the basis in the building with that sale. However, the 45L credit is specifically designed again for those contractors, regardless of when it is sold. So The big advantages that we're seeing here is, again, it is a credit, unlike a deduction. So a dollar for dollar reduction in your tax liability. There's also no credit recapture. And then the tax basis of the home will be reduced by the amount of the credit taken. Again, $2,000 though is a pretty small amount. So what we can do is go back 3 years. The credit will be applied to the year in which the home was first sold or leased. So we can go back as far as 3 years to amend a return for a refund. Next page, please. Okay, that was all old law. Just like 179D got some major updates, 45L also got some major updates as part of the Inflation Reduction Act. So starting this year, January 1st of this year, the credit available has increased from $2,000 per unit to $5,000 per unit if certain requirements are met. Some of the major changes that we're seeing is the height restriction. No longer is a building restricted to 3 stories, so long as it's been placed into service this year or later. And so what we're seeing now is already high rises getting in the millions of dollars of credits, in addition to the cost seg that they were doing in the 179D. So in some cases, we can, for a single high-rise residence, take advantage of cost segregation, 179 capital D, and 45L all at once. So we're seeing some incredible savings here just overnight since the inception of the Inflation Reduction Act. So as I mentioned before, there are some prevailing wage and apprenticeship program requirements associated with the new updates, just like 179D, and we'll talk about those in detail here in a little bit. The changes or requirements have changed. A building now must meet Energy Star requirements, unlike before where we were comparing ASHRAE 90.2 requirements. So I'm sure you've seen Energy Star on your appliances and windows and things like that. Well, now a home can receive that same certification. And if they do, they can get $2,500 per unit. That changes to $5,000 per unit if the building meets Zero Energy Ready Home Program requirements, and that is that the home is solar ready. And we'll, along with these slides, provide some specifics about that as well. Next pages, please. All right, a quick rundown of success story here. 130 single-family homes, single-family home builder, $2,000 per credit received, and that's a $260,000 reduction in their tax bill that they received last year as a result of our work. Next page, please. All right, last polling question. Are you interested in learning more from Cherry Bekaert? Yes, hopefully for everything, but we have some options here for everybody. All right. Let's move on.
Hey, Bill, I think we have a question in the chat box here. What if you have a 4-story multifamily apartments that you bought around 15 years ago? Would I qualify for any of the 45L if certain improvements were made?
Great question. So the incentive was created for new construction for a home, so single family or multifamily home. However, it does allow for substantial renovation. What substantial renovation is kind of left open-ended in the tax code. However, what we look for are brand new things like windows, new lighting, new HVAC systems, especially. But if you reach out to us with your if you reach out to us with with some specifics, we can provide some guidance on that pretty easily.
Thanks, Bill.
All right, one more question here.
Thank you for that question. We do have a bonus. We realize that there's been some, I'll say, polling challenges. So we wanted to make sure we had a bonus poll, which is number 5. Do you plan to attend the remaining sessions today? Yes, no, or unsure based on schedule? I'll allow you all enough time. I know that poll number 3 went a little fast for you all. And us. So we're hoping that the answer is yes. I hope you have felt that the session in regards to maximizing tax savings from cost segregation and then adding on a little bit more detail around the energy provisions, which was a follow-on to our presentation yesterday, specifically 179 Cap D and 45L were beneficial. So this does conclude our session. I want to again thank you for joining us. If you have any additional questions regarding today's topics or technical questions, please reach out to myself, Sean, Dat, or Bill. We very much appreciate you taking time out of your schedules to attend. We value your feedback. We always want to improve, and we'd ask you to take part in a short survey that'll be sent out after this session.